What's up, everyone? It's Buffett Analyst once again. Today we're going to look at some stocks. We're going to look at 52-week highs and lows. We'll look at some filters on FinViz. So I'm going to just get right into it. 52-week highs and lows is a good place to start. I talked a little bit about that in the last video. There are some of the ones that we looked at actually still on this list. AMR is a stock that Monish Pabrai has bought. Alpha Metallurgical Resources is coal stock. A lot of people still think that stock is undervalued. If we take a look at it right now, I can look at macro trends, Alpha Metallurgical. If I take a look at their price ratio history, PE, they're trading at around 8.75. Their EPS is way down. They had a huge increase in price from about $12 to $400 in the span of about 3 years. That was because of the rise in oil prices and um, probably mostly economic reasons. I personally don't like the volatility in such a company. It's not necessarily a good business to have such massive fluctuations in the price of the commodity it depends on. If you look at how that impacts margins over time, we see that if there is a big dip, margins go into the negative zone. You want to see more stability if you're looking for a long-term stock, but if you're looking for a stock to hold 2-3 years and drop, Monish Pabrai owns this stock and likely believes in that. American Axle Manufacturing. So these are very boring stocks, but this is kind of where you get the potential value. A lot of people overlook the most mundane ones. Um, let's see. Are they friendly to shareholders? So they repurchased about $10.8 million, but their free cash flow is more in the 200 range, so that doesn't look like a very shareholder friendly business. American Realty Investors. Let's see, Alto Neuroscience. What's that? Alto Neuroscience. ANRO. Yeah, so they're not doing so well. Let's see what's going on. Likely, if it's going down this much, their balance sheet is something to really look at. Let's see, they have cash on hand 82 million, total liability 16. They had a market cap at around 60, so that doesn't give a margin of error, margin of safety sufficient enough to invest. Apple Hospitality, REITs, I'm sort of skeptical on. It's not really a real cash flow business where they have a product and a customer. It's just redistribution of funds via dividends. Ardent Health Partners. I think we looked at this briefly last time. To revisit it, I'll type it in. I'm gonna look at their repurchases and free cash flow first. So they have, looks like, ample operating cash flow. If you take into account their capex, there is definitely much less. Sorry, this is laggy. Then we got repurchases, so they're actually buying, uh, they're actually selling stock rather than buying, so they're increasing the number of supply, which is not good. ASGN, I think, is that maybe agriculture, definitely industrial. If we look at their cash flow, let's see, they have about 10% in capex versus the operating cash flow. They have some stability in the operating cash flow. They repurchase quite a bit of stock. That is pretty significant. That's about like 90% repurchases. If we look at their efficiency, we can go here, other ratios. We can take a look at their return on equity, which will give us a good idea of how efficient they are. It's definitely a very stable business. An ROE of 11% though is insufficient. I'm looking for something at least 20% and up to have like a really good business. So I will just take a look at margins in case. Yeah, I mean, it's very, very low. This is likely due to its industrial nature. If I look up what it actually is. Um, okay, so they had a major drop recently, whereas, there we go. It's a leading provider of IT services. So that sort of explains why there was sufficient free cash flow. Um, yeah, I mean, this is interesting. You can definitely get some good efficiency from a software business. I'm not familiar with IT services so much. Recently dropped 50%. I'm gonna revisit their financials. ASGN. Um, Pretty impressive revenue growth quarterly. Yeah, probably the recent revenue decline is why the stock is down so significantly. Um, Let me see what their industry looks like. I'm gonna look up ASGN. They are in the information technology service industry. Let's see, PE of about 16. If I take a look at their historical PE, then we have hovering at about 10 to 20. This is definitely on the low end. We have about 17 PE with earnings per share of about $4. I mean, it's looking like they have a stability in earnings. Let's see. Yeah, this is sort of an interesting company. I mean, they have enough cash flow to return value to their shareholders. If we look at their shareholder equity over time, if we look at their retained earnings, yeah, so it looks like they're taking out their retained earnings to give back to shareholders, which is interesting. Let me see what they actually do. Okay, so we look at their 10K to find the business description. ASGN is a leading provider of IT in commercial and government sectors. SG has grown through a combination of organic growth and acquisitions, expanding IT. Okay, government agencies combined become 24% of their revenues. Yeah, I mean, today sort of the moat for a company is really software capability, and this company seems to do research in that area. But it looks like they're outsourcing. Oh, these are sort of enterprise softwares that they're using. This is interesting. I mean, they work with U.S. defense and intelligence agencies. to implement AI. It's actually very similar to what Palantir does. Palantir is probably a major competitor. Competition. The IT services. Yeah, I just don't know much about IT. Highly competitive with limited barriers to entry, from what they say. Yeah, it doesn't look like they really develop their own AI or anything. They sort of just piggyback off Microsoft and some other companies. Okay, here we go. Here's their revenue segments. Okay, so definitely majority comes from commercial, about 70%. Income, consulting metrics, oh, bookings, I see. Yeah, so it looks like they had a pretty big drop. I wonder why they had a drop in revenue. I mean, they do have very low margins, which is kind of concerning. Current assets. If I do a return on invested capital calculation, it would be operating. It would be operating assets minus operating non-interest bearing liabilities. So it would be 650. That would be about 700, plus PP&E, which is about 780. That's also going to be operating. So 780, 840. Goodwill is also operating. So about 2,700 million. And then identifiable, I'm just gonna tag that along against them. So that's gonna be 2,700. It's gonna be about $3 billion in operating assets. Operating minus anything that is non-interest bearing. So accounts payable, accrued payroll. So 3 minus about 2.5 is 750, 2,750. Other current 2,750, 2,650. Long-term debt, that's interest bearing, 2,650. Deferred lease, deferred income tax, 26. So that's going to be about 25. So 2.5 billion is their invested capital currently. And if we do average earnings, so over the past 3 years, average earnings is about it's about 220. So 220 out of 2.5. So it's about 8.8% return on invested capital, which is not very good. So I'm gonna skip this. IT services seem a little bit low margin to me to invest in. Avian Corp, Avery Dennison. Avery Dennison, what is that? Financials, cash flow. Let's see. Okay, sufficient operating. Repurchases. consistent price ratios. Let's look at PE currently. So pretty expensive. Debt to equity is going to be under 1, which means that there's more equity than debt. ROE is very good. Looks like they run a pretty efficient business. Margins are pretty low, though they have been increasing slowly over time. Okay, I'm gonna look straight at their SEC 10K, Avery Dennison. So let's see what they got. What do they do? Incorporated success. Okay, Global Material Science and Digital Identification Solutions. Supply chain efficiency, reduce waste, better connect brands, and tags. Oh, I see. So they're like a supply chain business. Supply chain solutions. Materials. Yeah, what is Materials Group? Leading global environment, pressure sensitive label and graphics industries. Label materials, tapes. This is interesting. Avery Dennison, MagTac, pressure sensitive. Metal foils, adhesives, pressure sensitive. Material. Wonder who their main customers are. Label materials. This is interesting. Including barcodes, QR codes, shipping labels, graphics, variety of films. Broad range of pressure sensitive, so you just sort of slap it on. That's basically what that means. Performance tapes. Electronics. Larger competitors in label materials. Oh yeah, 3M of course. Lintec, Flexcon, for graphics for large competitors. Orful, 3M, Tessa, SE, Nitto, Denko. So that's probably why they can't increase margins very well. Innovation, information, digital identification, provider. Research and development. So this is going to be their moat. Okay, acquisitions. That's interesting. All right, I'm going to start taking a look at their financials. I mean, this is a very mundane business. They do have extensive competition. Let's take a look at their financial statements. Okay, balance sheets. All right. Okay, let's do a similar calculation from last time. So we got receivables is about 1.5, inventory is about 1, so 2.5. 2.5, it's going to be 4, plus goodwill is about 6, plus other intangibles is about 6.8, deferred tax 6.9. Okay, we're going to add that pretty much all up, subtract cash and cash equivalents, so 8.4 minus 3 is about 8.1. So then we got liabilities, 8.1. This is going to be interest. No, that's not going to be interest bearing. This will be interest bearing. 8.1 is going to be 7.1. It's going to be 7.8. 7.8 minus 3 is about 7.5. 7.5 minus about 2 is about 7.3. I'm going to say about 7.3 for that. Other current, so about 7. 7, deferred tax, 7, so that's going to be 6.8. Long-term retirement benefits, 6.8 minus 0.4 is 6.4. Okay, so 6.4. value 6. And then what is their average net income over the last 3 years? Net 6.4. Okay, so that's going to average about 6, so it's going to be about 10% return on invested capital, which is not very good. Yeah, that shows efficiency, and so that's what we're looking for. We're looking for efficiency. Avient stock. You should see some of the return on invested capitals I've seen before. I mean, upwards of 20%, 30%. That Ulta Beauty is an example of a very, very high return on capital business. Avient, Thermoclassic. Interesting. It's another industrial business. Revenue, price ratios. Yeah, it could be. I mean, ROE is sort of a proxy for return on invested capital, but sometimes you can manipulate this number. However, this is clearly weird. They have these weird jumps in income, not very impressive growth, and their PE is way too high. No. Booz Allen Hamilton, what is that? After this, I hope to look at some magic formula stocks. I'll show you what I mean by that. It's interesting. Why is it down so much? It's about 15 PE ratio. It's a holding company. Everwatch, Aquilent, Brain Trust. Okay, macro trends. Booz Allen. Revenue, very impressive. Very, very impressive. PE ratio. PE ratio is about 15, even though their earnings have increased dramatically. This could be a good value stock. I don't know if it's going to be good for the long term. I'm sort of mixed, like how long I want to make these stocks. In past videos, I've said both not to sell ever and to sell, so it's kind of up in the air. They do have quite a bit of debt, which is kind of concerning. They have about 3-to-1 ratio of debt to equity. Are they shareholder friendly? Let's see, they have large repurchases. They recently had a huge reduction in free cash flow. What is this source from? Minus 573. Total changes in assets minus liabilities. So it looks like they increased. Okay, that's interesting. Chained earnings. Cash on hand. Let's see, what is their return on invested capital, and what do they do? BAH, 10K. Annual report. I'm going to look at their business overview. 110 years. Booz Allen. Wow. This is also a defense company. Cybersecurity as well. Yeah, it looks like people are selling off. ASGN was another defense company in tech. It looks like people are selling it off as Palantir increases in stock. There's like a negative correlation. Okay, I don't really care about your history. I'm sorry. I mean, to an extent, but not. Okay. A lot of DEI. They develop their own technologies. Yeah, I mean, it seems very corporate, like kind of fake societal benefits. Sort of just a money sucker. Oh, they probably gotten sold off because of the reductions in the budget. Yeah, there we go. I'm skipping through all those risk factors for now. All right, I'm going to look at their return on invested capital. Looks like I mean, a very impressive revenue growth, that's for sure. Primarily related to the purchases of computers to support operations. Furniture, yeah, not a lot of capital expenditure. Okay, so same thing, 2 billion, 2.1, 2.3, 2.5, 3.1, 5.4, 5.6, about 5.9. It's just going to be 6.5 minus 5, which is about 6. So 6 and then about 5, about 4.5, about 4.4 operating lease liabilities. That's going to have interest on it. 4.4, 4.3. And other, I'm going to put it in, or no, I'll count it against them. So 4.3. Average net income is, yeah, it is kind of highly fluctuating. Yeah, it's about 450. So it's actually very similar. They have another about 10% return on invested capital, which is not very good. All right, continue. Brinks Co. What is that? Cash handling business. It's interesting. Brinks Co. What is their ticker? Macro trends. Financials. Cash handling does not have a whole lot of future. Cash from operating activities. Oh my gosh, the website needs to work, please. Let's see, 300 left in free cash flow. They repurchase some of it goes to dividends. How expensive are they? Look at their PE ratio, it's about 25. I would not pay that much for this business. Canada Goose, Chegg, I've looked at Chegg before. Wow, 69 cents. Yeah, it's just, I mean, people are convinced it's going to go out of business. What is their balance sheet looking like? So they have $315 million in cash. Their total liabilities is about $700 million. That gives them a negative liquidation value. Yeah, it's hard to justify this. Pretty large reduction. Yeah, I mean, their business is kind of failing because of competition. There's not a lot that they can do except just sue Google, which is what they're doing. Canada Goose. I think I have looked at that before. Yeah, they're the apparel business. Cash flow. Purchases are not consistent at all. Not a lot of free cash flow. Yeah, it's sort of lackluster. If I look at their return on equity, it's going to be decreasing to about 17%. So you want to look at increasing, and that's a sign that they're not allocating capital very well. Chegg, Chatham Lodging Trusts. I don't really invest in trusts. Compass Diversified. 7.9% preferred. What is Compass Diversified? CODI. Okay, revenue. Let's look at their cash flow. For this types of negative cash flow. I don't want to pay for a preferred stock. In that case, even though it is safer than common. Crane NXT. Okay, it's about 16 PE ratio. I don't really care that the stock price went up. I just want to see how cheap it is. Those two things are not the same. Okay, ROE is not very sufficient. Very volatile and only in the tens. Deckers Outdoor. This is a shoe brand, correct? We got Hoka, right. It's UGG and Hoka and everything. Yeah. Looks like people are selling it off. Wonder what is going on with that. Other ratios. We have ROE increasing pretty dramatically. Very, very good ROE. Debt equity. Looks like they have no long-term debt. Also very good. What are their margins at? I can compare them directly with Nike. Their operating is increasing. Their gross is increasing. If we compare with Nike, what do we have? So operating margin, Nike, pretty comparable. Profit margin, surpassing Nike. Let's see. All right, let's see if they return capital to shareholders. So they have tons of cash flow. They don't have a lot of capex at all. And they do invest in repurchases. This looks like a good business, so I'm going to look at their SEC, Deckers Outdoor. Oh, and I forgot to look at one thing. I just wanted to see their PE ratio history. And that sort of reminds me, actually. Okay, so price ratios, PE, PS. Yeah, for some reason, People seem to be selling off significantly. Sort of, I think, hype and then the market tanks because it's irrational. What is a business? Global leader. Kind of know what they do already. That's the thing. Yeah, I mean this is pretty good. I just want to calculate the return on invested capital. And then I also want to do the same thing for Nike using the average net income. So, okay, so we have, it's going to be about 3 plus 4, so it's 0.7. It's about, it's about 8, okay, 0.8. Okay, 0.8, 1.1, 1.3. Okay, I'm gonna round that up to 1.4, 1.4, about 1, about 0.9, operating lease, 0.9, it's about 0.8, it's about 0.75, it's about same thing, 0.75, income tax, 0.7, other, okay, I'm gonna give them a more conservative valuation. So they have about 700 million invested capital, and then their net income is going to be around 700 million. Okay, well, let's do more like 500 million. 5 out of 700, or no, 5 out of 7, excuse me. 71% return on invested capital. That is very significant. Why is the stock price down so much? Question mark. Price to book? Is that what's going on? No. Do they have a recent bad quarter or something? 10Q. If I look here. Doesn't look like it. Net sales increasing dramatically. Net income, oof. I mean, it would honestly be good to hedge the bet, like with Nike versus Deckers, because it's not ever good to make a judgment call in terms of product. You kind of want to leave that up to the market. If I calculate their return on invested capital, it's going to be okay. No, 1.7. This is about 1.7, 5.7, 6.1, 13.6, 14.6, 15.4, 20.4, 23.4, about 25. It's about 30. 30 minus, okay, it's about 27.2, about 27, and then this is going to be about 22, and then 22 minus 2.6 is about 20, 19.4, and then some contingencies. 19.4 is their invested capital. Net income is going to be much less. It's about 5.7, 19.4. It's about 30% return on invested capital, which is very good. And they do have a long history of high returns on invested capital. Yeah, I mean these stocks are pretty undervalued actually. Deckers Outdoor and Nike. Nike is down probably at around $65 a share, $68 a share. And Deckers, yeah, Deckers has lost recently a lot. I'm just so curious why this happened. David Powers. I wonder why. Yeah, I mean, I guess it did go up significantly in the last 5 years, but yeah, this is sort of when you get into undervalued regions because you just wonder why. Why would it be so down? That is a very interesting idea. I'm gonna add that to the watch list. So, Deckers Outdoor. Who knew? And I also have Nike up there, I'm pretty sure. Do I? No. Should have Nike. I have it flagged. Okay. So yeah, these two are kind of promising. Deckers and Nike. And one could actually hedge the bet. Like if they aren't sure which brand of shoe is going to do better, buying now would not be a horrible idea. This might be because people are anticipating some kind of, yeah, I don't know. It's quite weird. All right. We got Elf Beauty. Trends, Elf. Oh wait, that's Ulta Beauty. Elf Beauty. Let's see. Wow, significant drop. Cash flow. Let's see. Kind of inconsistent. Barely any repurchases. Not good enough. Sorry. Alright, Eaton Vance, another trust, another fund. FNG Annuities and Life. If I could guess, that would be an insurance company. Do they have any information? Yeah. Okay. It's interesting. In these types of companies, you want to look at shareholder equity as a metric of growth. Sort of a weird volatility they have. This is very low margins as well. Yikes, yeah, that's not gonna happen. Alright, next we got Federal Signal. Federal Signal. 21 PE. Federal Signal. Okay, let's see. Cash flow. It's about 200. Purchases kind of insufficient, only 10%. Price ratios, let's see how expensive they are. Probably not going to pay very high amount for this. Maybe. Yeah, this is too expensive. Sorry. Alright, we got FedEx, which is interesting. How down are they? They're not down significantly, but yeah, that is probably true. It is a bad recession stock. Okay, so this actually might be fears of the recession coming in. Right. I mean, yeah, they're transportation typically does not do well in these types of scenarios, because it has so much overhead. Cash flow statement, if I go to their capital expenditure, is significant. Yeah, so it's about half of their operating. They do purchase shares, not very consistently. I would not invest in FedEx as well. They kind of have major competition from Amazon. Figs Inc. stock. Scrubs and other. Santa Monica. That's interesting. I know we kind of said something about them that they're not very smart to be in Santa Monica where it costs crazy amounts to go there. Repurchases, not very consistent. Not for me. All right, Floor and Decor, FND. Yeah, I mean, this is a good business. They have a pretty firm grasp on tiling. If we look at their cash flow, yeah, definitely growth over time. They do not repurchase shares, though. That is not good. All right, next, FrontView REIT, FTI Consulting. Corporate finance restructuring, forensic and litigation. Yeah, this would probably have I'm looking for impressive return on investment, or return on equity, I should say. It's only 13%. Margins, quite low. Except gross is decreasing. Is that because they're returning value to the customer? I'm not sure. Increasing. Not very good repurchase history. Let's see. Gartner. PE is 27. That's not happening. Hyatt Hotel. Oh no, Grief. American Manufacturing Barrels. It's interesting. Could be a good, nice, boring company. Grief Bros. Is that the same thing? Oh, yeah, it is. Grief? No, Grief. I hope I don't grieve over the stock. Cash flow. Net income. Stability. No repurchases. Why don't you just repurchase something? Alright, Hyatt. Hyatt is interesting. If this is a good bargain, Hyatt might be a good business to invest in. I just want to see if they own their own hotels or they're doing a management model, which is much more capital efficient. Ooh, that's a lot of CapEx. Wow. It's probably because they're building their own places. Yeah, I'm just going to check out the ROE just in case. Okay, it recently jumped quite a bit. I wonder why. Price ratios, PE. Yeah, I mean, this is like sort of surprising. I mean, we saw during COVID there was a big drop, but now they've sort of recovered. Let's look at their return on invested capital. Just do that calculation really quick. 10K. I mean, Marriott Vacations we looked at a while ago. I'm not sure if. Oh, what is this? There we go. Yeah, so they have. Oh, I didn't realize they own all these. Inclusive, yeah. What do they. What is their business model? Hospitality. Hotel portfolio. Yeah, we manage, provide services to, or license with the Hyatt branded hotel. So yeah, that's good. That means they have that management model that I was talking about. Primarily drive franchising hotel services. Yeah, yeah. So this is sort of like a shift in like I don't know if the market has paid attention, but like a lot of businesses that are big flagship hotels just slap their name on something and they create license revenue from it. It's become this really capital efficient model where it never used to be. Um, I wonder if all their properties show up on their balance sheet though. Yeah, so base management fees, segment results, segment revenues, other revenues. Yeah, yeah. Management is like where they make their money. Um, yeah, that is interesting. Owned and leased, comparable owned and leased hotels, occupancy, yada yada yada. It's not yada, but currently I'm just gonna look for the return on invested capital. It's coming up shortly. There we go. Yeah, French owned and leased, distribution. All right, restricted cash 0.372, 0.37, 1.49, 1.49. Prepaids 1.5. Okay, not a lot there. 1.5. This is gonna be about 3.2, 3.3, 3.6. Yeah, that's all going in. Okay, it's just 13 minus, which is gonna be about 12, and that's it. All right, so about 12 billion. Okay, 12. So far, not very good though. 12, about 11.5, about 11, about 10, 9.5, 9.3, 9.3. I'm gonna say 8.5. Other long term 8.5, 7.5, 6.7. All right, so 6.7 invested capital. What is their average net income? Average net income, it's hard to tell. These are our three numbers. 8.8. Yeah, it's about 10% return on invested capital. That's not very good. Yeah, it's not happening. I mean, they recently just shot up though. That's the thing. Like they recently shot up to like 1.3 out of 7, which is about 20%. But even then, and there's probably a peak in the business cycle. Yeah, not happening. Um, Sort of like the idea of this. Hyatt Hotels, innovative. That's another REIT. International flavors and fragrances. All right. CapEx. No repurchases. Not gonna invest. Invesco, another trust. J. Jill. Yet another fashion brand. Cash flow 6.3. No repurchases once again. KB Home. I think I've heard of this company before. Yeah, it's a construction company. 7 PE? 7? Wait. KB Home. KBH. Nope. Okay. KB Home macro trends. Alright. 38 years. Alright. Operating. Okay, only 10%. Significant repurchases, other ratios. ROE. Interesting. It's pretty stable. Debt versus equity. They have barely any debt. Oof, this is not bad. Profit margins. It's interesting. Okay, let's take a look at what they do. SEC, let's do KBH. I'm going to also quickly look at their PE ratio. Yeah, this is not a lot at all. Looks like it's a pretty cheap business. All right, 10K. Let's look at their overview. What is going on here? All right, one of the largest, most trusted home builders. We've been building homes since 1957. Build everything. Home building. Financial services. Net income. Home building revenue. It's probably because customers. Highly personalized. Customer obsession. Hold on, dude. That is a good sign. We believe in this highly interactive customer first. Meaningful competitive advantage. It looks like they read Jeff Bezos' shareholder letters, or at least copied them without knowing it. Working capital, operating risk. Investment land. Average relationships, products, standardized set. Build to order, elevation, KB Home, yeah. Utilize centralized internal architectural group, flexible floor plans, affordable choices to buyers, production, build to order, helps drive 2 months construction after we've signed purchase contract. Home Monterey construction, establish discipline skill, even flow pre-sale house. I don't understand this. In addition, generally commence construction after we have signed a purchase contract, obtain preliminary. Oh, I see. Oh, I see. So they sort of sell the home. Oh, okay. So they kind of sell the home first and then they build it. Wait, that's float. That's major. That could be float to invest. 70% of their homes are doing that. Asset efficiency. This is great. Selling prices. Increasing balancing price even. And deploying excess cash flow to help fuel additional revenue growth or reduce debt. Customer obsession. Find out what customers actually want. Continue to listen after the sale is done. Crowd satisfaction. Promotional partners. Innovative design. Yep. Backlog of homes under sales contract. Generated or cancellation. Dude, they have a lot of ending backlog. Competition. hurricanes, flooding, other natural disasters. Net orders. Alright, I'm gonna do a quick calculation of their reinvested capital. This is an interesting business, that's for sure. Revenues, housing, land, construction, homes delivered, average selling price. Yeah, this is gonna be cyclical. If I look at their margins, I wonder, are we in, what part of the business cycle are we in? It's kind of hard to tell. Financial results. Decrease in financial services revenues. Alright, I'm just gonna look straight at their reinvested capital, returning capital to shareholders. Repurchase our this is good. Okay, I'm gonna look straight to their stock compensation right after this. How do they incentivize their board and executives? Okay, 4 is gonna be 5.9. Okay, so it's literally just gonna be everything minus 6 of 6.2. About 6.2, 6.3. Accounts payable, 6. It's gonna be about 5.2. It's gonna be 5.2, 5.2. Okay. And then what is their net income? I hope this is not a disappointment. 5.2. It's on average gonna be. It's gonna be about 650 on average. So 5,200. So about 13% return on invested capital. Home building. Financial services, VIEs. That's interesting. I think they're sort of like they could be partly a REIT. Stockholders' equity. Cash dividend. PSUs, there we go. Director plan. No stock options. Restricted stock, there we go. PSUs. 3-year commencing. Cumulative adjusted earnings per share. Average adjusted return on invested capital. Revenue growth performance relative to a peer of high production public home building companies. Dude, this is so rare. This is so rare. Oh shoot, this could be good. KB Home. KB Home. Okay, I'm gonna save this for another video. I'm just gonna do a full video going through KB Home. And yeah. What are their competitors? KB Home. Competitors, we got Polk, we got Lennar. I'm just gonna take a look at Lennar's return on invested capital. Alright, financial statements. Okay, so they had about 13% cash. Okay, so it's gonna be everything minus 35.6 minus, so it's about 31. 41 minus about 4.6. 41.3 minus about 4.6. Okay, this is interesting. 37.3, 36.7. 36.7. Okay, and then minus 35, 35, 30. 32, 30, 30, and then 27, 26.8, 26.8, 24.8, and then about 24. Okay, so I'm going to say 24.5 as their 24 billion, that is, and their net income. $24.5, about 4. 4 out of 24.5, 16% return on invested capital. So they're actually doing better than KB Homes is. But what are their margins in compared operating? If KB Home is lower, that actually might be a good sign. Interesting. Okay, net also lower. Not much though. Yeah, I mean they do have this significant competition. What about their revenue? Wow. KB Homes versus Lennar times 10. KB Homes has only gone times 6. Lennar's grown much, much more. Yeah. I mean, doesn't look like they're having that much growth. However, this is kind of a significant. I mean, it's only P/E ratio of 7. Oh, is most of their stuff in the Southwest? That's interesting. What else? Okay. Well, I'm going to put that in the back pocket. I'm just going to add it here. We'll save that for another video. KB Home, K-Force. Nike is here. Pulse Group is here. Yeah, it looks like people are selling off the home building stocks, apprehending a recession, apparently. I'm guessing that's what this is about. Treehouse Foods. Winnebago Industries. Let's see. Manufacturer of motorhomes. Whoa. Subsidiaries, Newmar. Revenue. Could be interesting. Margins. PE. Whoa. Okay, yeah, this company's not doing very well. How about their book? Question is, did they have a history of consistent share repurchases, etc.? Yeah, this isn't very good. Well, 74. Yeah, I mean, not a lot of repurchases, that's for sure. Let's look at their return on equity. Yikes. Yeah, I probably wouldn't invest in this company. Let's see, Sealed Air Corp. That is a Buffett stock. He's owned that before. Under Armour, Westlake. I'm going to take a look at some magic formula companies. I'm going to skip over these, actually. Okay. All right. So these companies are sort of return on invested capital businesses. Why is this not working? No. Okay, maybe not. Okay, I'm gonna go back to this then. Yeah, when I get that to work, I will be looking at the website in a future video. They have some good ideas on there. I recommend you check it out. K-Force. K-Force. Cash flow. Hmm. Wow, impressive return on invested capital. I mean, return on equity. What's their debt to equity ratio? Not a lot of debt at all. Okay, what do they do? Actually, go here. And also one of these days I'll look through my watch list for you guys. Solutions, technology, finance. What exactly do they do? I hate these like ambiguous solutions businesses. Technology. Yeah, technology. What? Oh, consulting. This is interesting. Next update. There are a multitude of. Oh, staffing. I see. Staffing solutions. Hmm. Don't know much about the staffing industry, but I am interested in it. Free cash flow. Well, that's a good sign they actually care about free cash flow. Our dividend and share repurchase programs is mentioned. Revenue, 0.4 direct costs. Repurchases of common, not bad. Okay. Still not totally sure what they do, but let's see what their return on invested capital is. So point 2, I can always return to what they do. Point 2, 0.22. Okay, it looks like it's 3.57. It's going to be about the same. 357. It's about 300. It's about 260. 250. 200. Okay. All right, and what's their net income? 200. So it's an average of about 60 out of 200. 30% return on invested capital is pretty good. All right, let's take a look at their PSUs. This is a very short 10K. Where is that? Executive compensation, item 11. Where's item 11? Donde? Executive compensation. 2. All right, maybe I won't look at it right now, but what exactly is a staffing? What do they do? Deploying highly skilled professionals on traditional staffing assignments, both of which are considered temporary. Highly skilled professionals role 18,000. Qualified individuals on a finite basis. Oh, I see. So they're sort of like a team of mercenaries for professional services. Prioritize highly skilled talents. Looks like they're sort of transitioning into more technology based. Okay, it looks like they're sort of positioning themselves to AI, etc., which is good. According to this, expand a market share of the U.S. Believe that organic investments. Long-term shareholder values, efficiency. Rated strategy. Competition. This is an interesting business. I mean, they do have very high efficiency. Technology flex revenues temporary, quote unquote, hires. Consultants on assignment billable hours, a bill rate per hour. So it looks like they take some kind of commission. Oh, I see. Conversion revenue. It's kind of an interesting business. Like they sort of just like give, or they're like a talent creation pool. Not a lot of capital expenditures. What is revenue recognition? This is interesting. Permanent. Yep. Technology and FA. I see. So they're attributing their decreases in revenue because of the differences in traditional staffing. What? The Rabbi Trust? Goodwill, current liabilities, employee benefits, credit facility. Yep. Performance based. Okay, they didn't say what the performance is based on. Okay. Board oversight. Is there anything interesting in the let's take a look at the proxy. Proxy 8K 2024 12/31. Is this it? I'm looking for compensation proxy 12/31. Right. There we go. Okay. Let's see. Executive compensation discussion analysis. There we go. Oh, wait. Yeah. That's good. Performance-based pay. Target. Yep. 82% of total direct compensation. Okay, that's good. They want long-term stake in the company. Insider trading. Peer group, ASGN. Oh, that's interesting. We just looked at ASGN. Corn Ferry, Trulu, Hydric. Force percentile rank, market cap. 43. Okay, I see. Yeah, I understand. Where is the PSU compensation metric? Oh my gosh. Yep. Where is the... I don't understand. Why can't you just say where it is? Equity? Oh, okay. Wow. There we go. What is the performance goal? Oh my god. You've got to be kidding me. Where is the... Just looked through like 30 pages and nothing was there. Okay, great. Fantastic. DI, love that. Wow. Director compensation. Where is this? PSU. Did I just completely miss it? Huh? Performance. Yep, yep. Yeah, but what is the performance goal? This is so weird. Performance based. Annual incentives. Oh, there we go. Revenue and EPS. Objectives based MBO incentive. This is so complicated. Okay, but revenue and EPS is what they look for. I mean, it's not exactly efficiency, but KFRC. 18 is sort of expensive as well. Alright, well, I'm just gonna add it to the list. Interesting business. Kindercare, Night Swift, Night Cows, Levi Strauss. Pure Play Public Timeshare Company. What is that? Oh, I see. Okay. Hmm. Yeah, not very good. Capital efficiency for Marriott Vacations. Treehouse Foods. Wow. Hmm. Westlake Corp. Impressive growth. ROE is very down in the business cycle potentially. 21. Oh, not a lot of repurchases. Yikes. Yeah, not a lot of repurchases at all compared to how much they could afford. Wrestling Corp. What do they do though? Manufacturer of polymers. Yeah. Titan America SA. Belgium. Distributor of aftermarket parts. P ratio of 10. Could be promising. $76. Other ratios. Yeah, not very impressive. Simpson Manufacturing. Impressive revenue growth. Not a lot of debt equity. What's going on here? They do have stability in the business, which is a good sign. Cash flow stable. What was that? Big year for CapEx, whatever, 2022. Repurchases, pretty consistent. They could be gearing up for some repurchases. What do they do? Alright, Simpson. Subsidiaries, wood, concrete, and steel. Best in class field support. R&D, software. Wood construction. Connectors. Raw materials. Dependent on home construction, labor relations. Yeah. Manufacturing facilities in China. Yikes. I don't like that. Number of properties. Ooh, wow, they have a lot of exposure to Europe. Yeah.
Are you ready to play?
Yeah. All right. So I think that's gonna do it for today. Um, yeah, I will pick up off of the watch list next time. Take a look at some of the stocks there. Um, hopefully this was slightly helpful to understand sort of the skimming process. I found some interesting companies. Nike, Deckers, KB Homes, Kforce was okay. And then I'm gonna take a closer look at these in the future. So, hope you enjoyed and have a good rest of your day.